So, if you've been online at all in the last couple of weeks, you've probably noticed all of the panic around investing. The S&P 500 has been dropping, the Mag 7 is getting hammered, and Bitcoin is down something like 30% from its all-time highs back in October. Sentiment just feels pretty low right now, and honestly, it seems to be getting a little bit worse every single day. And a lot of people are calling it an AI bubble, basically saying that AI isn't as profitable as everyone thought, and maybe that we overestimated how fast it could change the world or how quickly these companies could monetize it. And meanwhile, we've been pouring money into these big tech stocks thinking they'd go up forever, and now people are wondering if there's even going to be a payoff. So, yeah, people are panicking and they're selling off their shares. And I'm sure you've got this little voice in the back of your mind saying, what if this crash is different? What if all the money I've been investing is tied up in assets that might drop for months or even years? And honestly, I've been feeling that too because I'm relatively new to investing, with only 3 or so years under my belt right now. And during that whole time, we've basically been in a bull market. My portfolio has mostly just gone up, and aside from Liberation Day, it's really been green almost every single month. So, yeah, part of me can't help but wonder, what if this time is different? Should I be reallocating? Should I be building up cash? Am I just being naive? And what should you actually do? Is it smart to start selling off shares and locking in those gains? Should you build a big cash reserve in case we're heading into something like a 2008 style recession? Well, I think the answer is neither, and I wanted to go into why this could be an opportunity you've been looking for without even realizing it. So, why do these market dips always feel so dramatic? And honestly, I think it comes down to one thing, and that's the noise. And for new investors, that noise is one of the biggest enemies you could face. If you started investing in the last 2 or 3 years, it's probably felt like investing has just been a money printing cheat code. There's been so many mornings where I'd check my portfolio and it just is a wave of green. It felt predictable, it felt easy, and it felt like as long as I kept putting money in, I'd wake up with a little bit more the next day. But that creates this false sense of comfort. And when the market finally does dip and correct, you're just not mentally prepared for it. And then you add in all this extra noise. You turn on CNBC and every ticker is a bright red symbol, or you open TikTok and there's all these experts saying that we're heading into the next 2008 Great Recession. So then you go on Reddit and people are asking if their money is safe or whether or not they should sell everything or what they should rotate into. And the crazy thing about all of this is that most of these people are brand new to investing too, and they don't really have any idea what they're talking about. That fear just spreads fast and it infiltrates your mind way faster than any logic. So if you're not careful, that panic just gets in your head and it makes you doubt your plan. And if you act emotionally, it can be devastating on your long-term financial picture. And it's really just based on someone else's fears rather than your own long-term thinking. So like I was saying, the S&P 500 has basically been green for the last few years, and it's just been consistently rising over time. So when it does finally dip, your brain is going to immediately jump to that worst case scenario. And your brain is just trying to protect you from that feeling of losing money, even if acting on that fear means that you end up making much worse long-term decisions. And this is exactly what happened to a lot of people in April of 2025. The market had been rising steadily for months. Everything felt normal and predictable. And then, out of nowhere, in one instant, Trump's tariff announcements came out, and the market just immediately dropped. And a ton of people were freaking out and selling their positions on the spot. And I remember feeling pretty anxious about this too, because I just saw my net worth falling in real time. And I was second guessing whether or not I was making the right investment decisions this whole time, and if I should have been allocating my money differently. But still, me and a lot of other people realized what was actually happening and just stayed calm. And those two reactions, the panic selling versus that steady, confident investing, that ends up creating two very different financial futures for all people involved. So, a lot of people got completely shaken out during that dip. They saw the drop, panicked, and sold everything. But there's also people that looked at the exact same situation and saw an opportunity. Those people were using the dip as a chance to buy as much as they could while the price was low. They understood that nothing fundamentally changes about those companies, only the price. And today, those people are noticeably ahead. The ones that stayed calm, kept buying, or even just held steady, their portfolios recovered and then just kept climbing from there. Meanwhile, the people who panic sold locked in their losses and had to sit there watching the market bounce back without them. And I think this is one of the most important mindset shifts for anyone in their 20s or 30s. Wealthy investors don't fear dips, they use them. They actually look forward to moments like this because they understand that dips aren't a sign of failure, they're opportunities. The media will always dramatize these downturns, where everything looks bright red, the charts get exaggerated, and the headlines are basically engineered to freak you out. And it's not because it helps you, it's because that panic gets them clicks and views, and in the end, it just makes them more money. But your job is to see past that. Because if an iPhone went on 20% off during Black Friday, you wouldn't panic about it. You wouldn't assume that Apple was collapsing. You'd take advantage of the discount while you had the chance. And this same logic applies to stocks. When the market drops 10%, most people freak out and assume something fundamentally is broken. But the reality is that you're just getting the same asset but at a discount. And at the end of the day, you're buying appreciating assets. Your long term goal is to accumulate as many of those assets as you can over the next several decades. So dips actually accelerate your progress. The lower the price, the more shares you can buy with the same amount of money. And it's really that simple. And if you're in your 20s or 30s with retirement decades away, you shouldn't be worrying about the day to day price. The only thing that matters is the amount of assets you're stacking in your account every day. So let's say you wake up a week from now and the TikTok experts ended up being right, and it turns out that we really are headed into a recession that people are comparing to the one in 2008. Here are the things that you should not do. First, don't take advice from panicked strangers online. Most of these people have no idea what they're talking about. They're scared, they're emotional, and their fears will very quickly become your fear if you let it. Second, don't refresh your portfolio every hour. Refreshing it over and over again isn't going to make anything better. All it does is make you more emotional, and staring at that screen all day just urges you to panic sell, and that's the exact behavior that will hurt you in the long term. Next, don't make emotional decisions. This is the fastest way to destroy years of future gains. When you combine fear, constant checking, and watching everyone else freak out, your brain will convince you that selling is the safe thing when it's almost always the worst thing that you can do. And finally, don't be doom scrolling financial news. Watching the live tickers, reading those dramatic headlines, and consuming this constant crisis content is not going to change anything that's happening in the market. All it does is amplify your anxiety, and you just need to find something else to do with your time. Like anything is literally better for your mental health than obsessively watching charts crash in real time. Now, here's what you should be doing. First, you need to zoom out. It's important to remember that over a 20 to 40-year timeline, none of these short term drops have ever really mattered. The market is always trending upward in the long run, so in the short term, even if it feels huge right now, this doesn't really mean anything in the big picture. Next, check your cash reserves and see what you have realistically available to invest. Dips are one of the best times to put money into the market, even if it's just a little bit. Buying something simple like a low cost ETF, such as VOO when prices are down, is one of the most straightforward ways to accelerate your long term progress. And if you're able to, you could even consider picking up extra hours at work or finding small ways to increase how much you can invest. You don't have to go overboard with it, but even a modest boost during a dip can compound massively over the next few decades. But once you've done all that, I think the most important thing to do is just detach. Step away from your computer, put your phone down, and re immerse yourself in your actual life. You could make a cup of coffee and read a book, or take a walk if the weather is nice. Do some grounding in something real. It's easy to forget this, but your life is not contained inside of a chart on your phone. The market will move however it wants, but your peace of mind doesn't have to move with it. I think another great example of this market sentiment was during COVID, because back then people genuinely thought the world was ending. And a lot of people panic sold everything they had in the market because it felt like the only safe move. But other people looked at that same situation and saw the opportunity. So they started buying and they stayed calm. And ever since then, the market has just completely taken off. Those investors ended up seeing some of the biggest gains of their lifetimes, not because they were smarter, but just because they were patient. The market really does reward patience way more than it rewards intelligence. So just remember, anyone can invest when the stock market is only going up. That doesn't take any discipline, it doesn't take patience, and it's easy. But how you react when the market starts to dip, that's what actually defines your financial future as an investor. If you can train yourself to see dips not as setbacks, but as opportunities, that's how you can quietly build wealth over time. And if you've made it this far, you're already thinking differently than most people, and I appreciate you watching. If you enjoyed this video, feel free to leave a like and subscribe, and I'll see you in the next one.